Hello guys, I'm Praveen Khaitan, and today we will discuss about repurchase agreement and financing from operational and integrated risk management subject of FRM Part 2 curriculum as recommended by GARP. And this agreement is more about short-term financing, which normally any financial institution seeks if they need overnight borrowings, and some banks use it for their cash management because idle cash do not produce any return, so they are involved in overnight repurchase agreements. So let us discuss further. Now, what are repos or repurchase agreement? Now remember, there are two types of repos. One is about selling GSECs, government securities, in order to take the short-term overnight borrowings, and that is done by different financial institutions, and one person or one institution can sell it to another institution for cash, and then later on it is repurchased. So we will discuss about that. And another repo rate is normally given by the Fed Reserve or the RBI, where RBI lends money at the repo rate to the commercial banks. So these are somehow similar, but here we are talking more about the repurchase agreement between different banks or the financial institution, maybe companies also. So what is a repurchase agreement between these companies? So repurchase agreement is a short-term loan secured by collateral. So you are taking a loan, so one person or one company wants short-term loan. So this company has bonds with them, normally government bonds, which has high credit rating. These are risk-free bonds normally. So these borrowers has bonds with them and they want cash in exchange of the bond, and normally these are overnight borrowings, but yes, it can extend for a few weeks or maybe few months also, but these are money market instruments, so it is less than 1 year. So one person or one company wants cash, so they keep the bonds as a collateral with another financial institution, and they take the money from them, and they normally utilize it for their short-term needs, and the next morning they pay back the cash and collect the bond. So it's an overnight borrowing, and quite possible that they don't want to get it back, and in that situation they renew the repurchase agreement, repos. So basically it's a contract between two companies where one party sells a security bond at a specific price with a commitment to buy the security at a future date at a higher price. So what happens is the difference between these prices are the return for a bank. So we'll take an example and understand this concept. And the term repo refers to the transaction from the borrower's side. So a borrower promises to buy securities back which he deposited. So let's say you are a borrower, you sold your bonds or you put your bonds as a collateral and took cash. So tomorrow you're going to give the cash back and collect back your bonds. So when we see the same transaction from the angle of a lender, okay, so the transaction is referred as a reverse repurchase agreement. So normally reverse repurchase agreement, they get benefited, the interest is higher than the repo. Now this is normally not done directly. There are dealers in the market who brings in these two parties, okay, and they charge commission from both the parties. Okay, that could be some basis point. So they charge maybe 1 basis point or 2 basis point, not more than that. Remember, 100 basis points is 1%. Now let's take an example. Suppose that on January 1st, there is a blue bank and they want to borrow around 12 million till 31st January. So therefore they sell XYZ secure bonds. So they have some government securities with them with a face value of around 10 million. So this is the face value. But the market value of that bond is 12 million. Okay, and they want to sell the bonds to yellow bank, or you can say they want to keep it as a collateral with the yellow bank, and they want to get 12 million in cash. At the same time, the blue bank agrees to buy back the bond on 31st January at a contract price plus 0.4% interest. Okay, now this is an annualized interest, remember. So when you see the quotation in the question or anywhere written, this is annualized question, interest rate, and you have to convert it for a month or a day. Now in this situation, the blue bank wants money for entire month. So what will happen at the repurchase time? So repurchase price would be around 12 million plus the interest on that comes to around 4,133 dollars. So 4,133 is basically the repurchase price, and this is the interest which is higher than the normally repo agreement. So this is the return for any bank who are interested in repo market. So if you really want to see the repo agreements rates, how it works, I'll show you a website. Hold on, give me a second. So we have a website, we have dtcc.com here. Now we can see here there's the DTCCGCF repo index, which is for basically government security based repo index, and these instruments, these are cleared at government securities divisions of the fixed income clearing corporation, and the index rates are par weighted average of daily activity in the GCF repo market and reflect actual daily funding cost experienced by banks and investors. So they almost reflect the actual funding costs by banks and investors. So companies and banks both can participate in the overnight repo market, and we can see here the weighted average rates every month. It's a monthly weighted average. Basically the month's highest, the maximum is 1.538 and the lowest is 1.372 and the average is 1.44933. So this is for the month of Feb last year 2018, and now right now the repo rate has increased. So the repo rates are increasing in the market, and this is the total par value in billions. So this is the face value of the bonds. So this is the par value of the bonds, and this is around for every month we have January, like it has started, so not too much difference. But here we can say there is a deal of around 2,198 billion in billion dollars, and the minimum for a day was around 83 billion and maximum for a day was around 162 billion. So you can see this for the entire year, and if you want to compare for the months, like you need to have the past year data. You can compare how the repo market is performing as compared to the previous year same month. So you need to get the historical data along with this. Now let's get back. Now remember one more thing, the day count convention is calculated as 360 days, based on 360 days. So most of the money market instruments, not every, but most of the money market instruments are actual to 360 days. So 31 days actual to 360 days you have to use to calculate the interest cost. Now, so what are the motivations for entering into a repo? If you see the borrower's perspective, the cheaper interest, this is basically cheaper interest rate for borrowers. Now why do we call it a cheaper interest rate? See, normally the repo rates are backed by government securities or the collateral, so these are obviously cheaper than the unsecured borrowing. So you're looking for an overnight borrowing which is unsecured, obviously the interest rate will be higher. And if you are taking a secured loan or secured borrowing, the interest rate would be lower. Now, second motivation is like bond financing. So Repo can also be used to obtain cash to finance a long-term bond position. Now, this is good one. So suppose Blue Bank in the previous example had purchased the same 10 million face value XYZ bond from the market. So what he can do is it can sell it in future at a higher price and make profit. So with this motive, he purchased the bond. So until he finds a buyer, okay, and sell the bond, he can finance his bond purchase by borrowing cash through an overnight repo rate. And then he can, renew it or roll over this position until and unless he is able to sell that bond to make profit. So this happens. So I am investing somewhere, I'm buying bond. So I invested, I purchased bond, now I have bond kept with me and my cash has, dried. So I want to recapitalize myself. So what I do, whatever bond I have, until unless I sell it in the market at a higher price to some new buyer, what I do is I put that bond as a collateral with some other institution and take the money. Now, why I want to keep it into the repo market? Because I can encash it any day and I can, buy it back anytime. Okay, so that is the best thing, because let's suppose I have a buyer ready tomorrow. So I can immediately buy back bond and sell it to the new buyer. But I am taking a long-term loan based on my, bonds I have, then I would not be able to, uh, withdraw that bond and sell it to the new buyers. So repo market is more liquid and more flexible, and they can provide great liquidity anytime required with the companies. Another thing is that yes, companies also use the repos for liquidity management. So firms can borrow fund normally in two ways: short-term and long-term fund, debt equity or debt issuance, or equity selling. Now, normally equity selling are costlier. So if you sell your equity, the expected returns are higher in the market, as we have already discussed in FRM1. And if we talk about the debt instruments, now debt instruments are comparatively cheaper. So repo offers secured short-term financing, and they are considered less stable as companies need to pay repo within a short period time, and rollover rates change due to market condition and sentiment. Now this is a problem with repo. But on the other side, if we talk about equity financing, it is considered more stable because you don't have to pay back money of investors in near future or immediately. But yes, you may have to pay dividends, but assuming that you don't have to pay periodic dividend on a regular basis, let's suppose. So equity financing does not need to be immediately paid back. So this gives you more stable source of fund. But repos are like you have to renew it every day. So this is not stable. But yes, equity financing is expensive as compared to repo. So in any company, you don't need long-term funds always. You need long-term funds as well as you need short-term funds. Why short-term funds? Maybe for your working capital use. So let's assume I'm a company, I'm having 10 million as surplus cash. Okay, and I need, let's say, 1 million as working capital, 1 million as working capital to meet the daily need of, or monthly need of company's expenses like salary, electricity bill, and all. So I have surplus money with me. Now, so what I can do with that money? So this is from the seller's prospect. So I can simply put that money into bonds. I'm so sorry, I'm talking about the buyer's prospect. So we can keep that money we can invest that money in bond. So we purchase the bond and we have good returns from those bonds. And we have 1 million for our daily cash need. But suppose we need maybe 2 million someday or 3 million someday due to certain reason, certain expenses you have in companies. Now, how do I get that short term uh, loan? So I can either go for an unsecured loan, or then I can go for a and take the money in repo market. So because repo markets are secured by bonds, so these are less costly as compared to unsecured loan, and it can fulfill your short-term cash need. So you were short on cash because you invested all the money into bonds. Now you have bonds. So what you do? You sell the bonds or keep the bond as collateral, take cash, utilize that cash for your short-term needs. When you receive the money back, you go back to the lender, you give them money back and take your bond back. So this helps in cash management or liquidity management. Okay, so basically idea is this: you don't need, you know, always only the long-term capitals. You need short-term capitals for short-term needs, short-term expenditures. To manage that, you can use your bonds as a collateral, get the cash, use that money, and then buy back the bond. And this thing will give you some extra return, right? It's just like liquid funds. You can invest into, you have surplus money with your bank. Now that is kept into your current account. Now the current account does not give you any return. So what you do? You put that money into liquid funds. Okay, and when you need it, just and near the end of month, okay, you sell the liquid funds, you get the cash, you pay the salaries to staff. But this entire month, you get some return on that idle cash, which you would not have got or received on a current account. Okay, so this is good. People do it. Now, if we look from the angle of lenders, we have already discussed. So this could be an investment instrument for a company, and lenders use repo, okay, for investing, as idle cash do not give any returns, as I have told you. So you can sell it into the repo market, gain some extra return, because in current account it will not give you any return. So many mutual fund companies hold cash as a buffer for safekeeping. So they can often use short-term maturity investments, okay, overnight borrowings or maybe a month, so they can generate some extra returns. Okay, it will be better than holding idle cash. Municipalities also, okay, they have a lot of cash with them, so they can invest in repos and they can get some extra return from those things. So investor may also contract in open repos by lending for a day under a contract that renews each day until it is cancelled. So normally open repos are renewed every day and unless you cancel it, and you can cancel it any day. If you need cash, you withdraw that funding. Now there are haircuts, okay, in repo market. So what is haircut? Basically, collateral includes securities issued by governments normally, so they don't have risk as such. But there are market situations like we faced recession, we faced economic slowdown. So there are situations like in India right now, banking sector is little under pressure. We had ILNFS defaulting, and we saw price crashing of DHFL. So there are situations where the bond prices are declining. So there is a risk. So what these companies do in repo market, they go for some haircut. Haircut means they discount the value of a collateral. So let's suppose in previous example we took, where the yellow bank wanted 12 million loan on a 12 million market price bond, the investor would be interested in not giving 12 million loan, but for a security of 12 million, he might be willing to lend only 11.5 million. So 50 million he is keeping as a buffer, quite possible if the bond price goes down. So there could be risk. So in this kind of situations, most of the repo transactions are also subject to daily margin calls, just like we used to receive in futures contract. So we need to maintain the margin, so we can have a daily margin call. So a margin call requires a borrowers to deposit extra bonds. So if the value of bonds goes too much down, so for example, I'm issuing you 12 million against 12 million bond, but now value of the bond remains 11 million into the market. Okay, so I can ask you that if you want to carry with the repos with the loan, you need to deposit more collateral. Otherwise, take your bond and give me my money back along with the interest. Okay, likewise, if the bond values are increasing, so the company who has borrowed the money and deposited the bonds as collateral can withdraw the excess bonds, okay, which is given to the lender. So that is also possible. So we have a daily market settlement where excess bonds are withdrawn, and if extra bonds are needed, uh, the borrower can deposit those extra bonds. So this happened during the 2007-8 crisis also, where the Lehman Brothers was borrower, and the JP Morgan, I guess, was the third party agreement as kind of a lender. So they were not actually the lender, but they were arranging the funds. So when the market crashed, the value of the Lehman Brothers bonds declined drastically, and the JP Morgan denied to encash the bonds. So that was a time where the Lehman Brothers defaulted, and they raised their hand and denied in paying all the debt obligations. So repo has risk in case of bad market. So if we see from the lender's perspective, it could be used as a financing vehicle. So lender can use repo to finance short-term sell positions in the bond, and consider if a firm has a view that interest rate will rise and bond price will fall in near future, he can obtain the desired bond collector through lending cash in a reverse repo market. So it would then short sell the bond and buy it back when the market price falls and get profit made from the trade. So this is also possible. So normally financiers do this thing. They can short sell the bond, and they can make profit with the short selling. Also, they are safe because if the bond prices are falling, they can ask for extra collateral also, okay, from the borrowers. So it is pretty safe for them. There is no as such issues. Right? Now, is there any counterparty risk or liquidity risk in repo? Now, if we talk about the counterparty risk is very less, because most of the bonds are, deposited as collateral in this market are government securities and, high rated bonds. And so the counterparty risk is limited, because if the borrowers defaults in paying loan and interest, the lender can sell off the bonds and recover their money. But yes, in case of economic crisis, if the bond value decreases badly, then there could be a counterparty risk, and the collateral will not be sufficient to recover the entire money. However, in normal market, we don't have counterparty risk in repos. Yes, but it has liquidity risk. Now, liquidity risk of uh, can be due to adverse change in the value of bonds. As I told you, if the market crisis or the crashes and the price of bond goes down badly in case of an economic event, uh, it can be a particular concern to the lender. So as lender may not recover its full investment. But this risk can be mitigated by use of haircuts. So let's say for a 12 million bond, you might be showing only 10 million because you feel the near term the bond price may go 10%, 20% down. So you can have bigger haircuts. You could have strict margin calls, and you can also have a very short term repos issued overnights, maybe maximum or 2 days or 3 days. You cannot go for a week or a month. So these mitigation things you can use to reduce the liquidity risk in the repo market. So that's quite possible. Now, next we have to study what uh, and how repos performed during the credit crisis in 2008. So we'll study about the Lehman Brothers and Bear Stearns during the 2007 and 2009 credit crisis. What happened then? So we will study this in next session. Till then, just take care and catch you in the next video.